Welcome back. Yatheen Singh from Momentum Securities joins us now for a look into the day's trading session. Yatheen, thanks so much for your time today. Now, one would have thought it would be a slow start to the week, with trade somewhat muted as U.S. markets are closed on account of Martin Luther King Day. But President Trump cannot stay out of the headlines. And here we are with markets in the red on the back of those tariffs. What are you making of this move, this risk-off mood we are seeing in markets at the moment?
Quite aptly put, I think the biggest risk, or rather sentiment risk of 2025 just won't leave us behind in the previous year, as this resurfaced with President Trump threatening escalating tariffs on over 8 European nations, including parts of the UK and Norway. But just before we get into a bit more detail on that, we did see the oil share, closing the session up 0.1%. As you mentioned, to a large extent, this was supported by strength in Resi, with the Resi index again gaining 1.8%. Again, investors are seeming to lean more into the risk-off positioning, which we did see towards the kickstart of 2026. Now, coming back into the whole tariff sentiment and the picture surrounding that, we did see EU leaders did call for an emergency summit, again, in an effort to coordinate their response. Again, potential measures that we did see included, to a large extent, some retaliatory tariffs. Again, this would come to the vector of up to 93 billion euros, and this would actually be charged on US FMCG particularly. And it also activates the EU's anti-coercion instrument. Again, these, in our opinion, is fairly far-fetched, and to a large extent, this has, or rather, we have viewed this as being worst-case scenario measures, because U.S. officials, including the Treasury Secretary Scott Bessent, did argue that the EU cannot secure Greenland strategically. So again, Washington frames this entire clash as a national security risk, and therefore it does actually involve critical minerals issues. So again, markets have been remaining surprisingly calm with this, with US equity futures also remaining fairly flat. So this time again, the pathways to de-escalation are also fairly less defined as we did see in 2025. So it's still very much a wait and see from this point going forward.
Talking about a wait-and-see game, and as we are seeing those tariff risks rearing their head yet again, there is that Supreme Court ruling around Trump's tariffs, and this, of course, could then nullify the tariffs and these threats we are seeing at the moment. Is that something you're watching closely?
Yes, that would actually be one of the highlights going into 2026. Especially looking at that, coupled with the fact that there are currently several subpoenas that are currently on hold surrounding the Federal Reserve independence. So I think those are two factors that are likely to play into Trump's plan. The former obviously not playing into his plan, as they still never agree on an effective tariff rate. But I think that combined with the overall lingering story of the Federal Reserve independence, coupled with the big beautiful tax bill and how is it going to be funded, whether there's going to be further withdrawals from the TGA or not. And those are also vectors that are still going to be on investors' minds going forward.
Now let's get into some corporate action. Earnings season picking up globally, particularly in the US. Netflix out with numbers tomorrow. If my memory serves me correct, it missed on expectations in Q3, leading to a slump in its share price. What will you be looking out for when it comes to those numbers? Also considering that the group is engaging in, in big M&A activity this year.
So historically, the fourth quarter does tend to favor US media counters more, just purely from a consumption perspective. So we do know that Netflix is expected to deliver their full year for 2025 results tomorrow. But I think what's going to be most monitored within that print would be the proposed acquisition of Warner Bros., as you mentioned. Again, it's a deal that combines Warner Brothers' deep content library and HBO, two of which are leading streaming services within the US, and the global prestige alongside their profitable distribution network with that of Netflix's global platform. Again, strategically, this is quite a powerful collaboration if it does come to fruition via an acquisition. But then again, it's the key question to investors is how much of a premium does it come at? And again, it does introduce in a whole new range of regulatory integration and earnings volatility risk alongside that. But then again, these factors are not as instrumental in driving a detrimental case towards their earnings below their current targeted 20 to 25% medium-term EPS growth target. I think in terms of the industry as a whole, in terms of media streaming within the US, it is facing a fair degree of tailwinds at this point in time, which again includes digital distribution benefits, consolidation, and overall consolidation of the industry, and also expansion amongst sports rights monetization.
And before we get into your stock pick, I see Cecil still shedding losses. The last time I checked, it was down 2%. Is this still on the back of that JP Morgan downgrade, or is it moving, I guess, in correlation to what's playing out in markets at the moment?
Yes, quite aptly said. I think that the risks mentioned within the JP Morgan reports are certainly valid because Sasol does face earnings pressure in the near term, as the stronger rand obviously weighs down on its largely dollar-linked revenue, right? But despite Friday's sharp 11.8 sell-off, I think that the operational support still remains firm, and this does include, or rather comes on the back of two key vectors. Again, the operational improvement from the destoning project turnaround, and also to a large extent the title capital allocation that we are seeing at a group level. Again, a stronger ZAR does benefit their rand-denominated debt, although their working capital risk does persist around NatRef and Prax going forward. Again, I think that investor attention here again is going to be more centered towards better destoning yields, reducing their external coal purchases, which will obviously bring down their cost curve, and then again, stabilization in global chemical prices. However, I must mention the last is more of a prayer than an expectation.
All right, let's get into your stock pick. We've got about 30 seconds.
Sure. So in light of the recent bond yield compression that we did see throughout 2025, with the SA now down to, with the SA 10-year now down to 8.5%, and we are looking at SA REITs in far more detail. Again, the growth prospects have improved, as we know that lower bond yields does impact profitability, albeit with a lagged impact. So we are seeing lower funding costs, stronger liquidity, and high quality income. Therefore, my pick is Emira, because Emira's portfolio has reshaped into a much leaner, higher quality asset base. Again, a lot of it being as a result of disposals, of funding more accretive reinvestment. They also hold a very accretive US portfolio as well, accounting for roughly 17% of their international portfolio.
All right, Emira, one to look out for. Yatheen, thank you so much for your time and sharing your insights with us this evening. That was Yatheen Singh from Momentum Securities.